Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. In this episode, we discuss anti-ESG investing. And we know that oil and natural gas prices have skyrocketed over the past few months, and this rally was supercharged by the war in Ukraine, and also because countries around the world are pivoting from fossil fuels to cleaner sources of energy. So investments in fossil fuels have plunged over the past decade, and cleaner sources of energy, renewable energy, that is not yet ready to meet the rising global demand, probably for years to come. And many are now blaming ESG investing for oil price shock because the big three asset managers, BlackRock, Vanguard, and State Street, have been impressing ESG standards on companies that they invest in. And in fact, investors have also cooled on these ESG ETFs lately because these ETFs typically have a lot of exposure to big tech stocks, and these are underexposed energy. So when tech did so well over the past decade, ESG investing was all about doing good and at the same time beating the market. But energy was the best performing sector in 2021, and it is the best performing sector year to date. So ESG ETFs have underperformed, and inflows into ESG ETFs have slowed down significantly. Some of these ETFs have even liquidated. Recently, a new financial firm called Strive Asset Management, they launched a new ETF which wants companies to focus on excellence. This firm, Strive, is backed by some very high-profile investors like Peter Thiel and Bill Ackman. They launched their first ETF recently, DRLL, and this ETF would use its shareholding voting power to encourage U.S. oil and gas companies to drill more and frack more. So my guest today is Matt Cole, Head of Products and Investments at Strive. With Matt, we'll talk about the story behind Excellence Capitalism, the investing philosophy, and also how Strive plans to compete against the biggest asset managers in the world. Joining me now is Matt Cole. Matt, welcome. Great to have you on the show.
Hi, Nina. Thanks for having me.
So tell us a little bit about your background and Strive to start off.
Yeah, so a little bit about my background first. I've been in the investment industry for over 16 years, primarily on the fixed income side. Started off as an analyst covering all different sectors in corporate America for corporate bonds, high yield bonds, investment grade bonds. Moved over to the trading side with structured securities, so agency mortgages, and became a portfolio manager at CalPERS. I was managing over $70 billion, primarily active funds, and had a lot of success there. And while I was at CalPERS, I witnessed firsthand the change in the investment management industry. So the introduction of ESG, call it in 2018, 2019, when Business Roundtable happened and over 200 companies signed on, changing the definition of a company, the purpose of a company from the old shareholder capitalism model to the stakeholder capitalism model. I had a front row seat at all those instances, and it was just something that really piqued my interest as a fiduciary to our clients. What is the proper role of an asset manager? How should an asset manager be engaging in the corporate governance process? And I found it very impactful to returns in the industry, and something that just really piqued my interest and eventually led me to Strive, where just taking a first principles approach thinking about what is the right solution to corporate governance, I really felt that it was removing any social or political agenda. And what's interesting about that statement is that many of those social or political agendas I actually personally find noble and interesting conversations, interesting debates to have. But I find the asset management industry the wrong place for that discussion. I think they are discussions that we should have through the political process where every citizen has one vote, one voice, not through the asset management industry where a handful of corporations are the largest shareholders for effectively every company in America. And so when I heard about Strive and was introduced to them, it really just stuck out to me as the right answer to this problem, and was excited to hop on and join the movement.
Very interesting. So I took a look at the website, your website, and the mission statement reads, I quote, "Our mission is to restore the voices of everyday citizens in the American economy by leading companies to focus on excellence over politics." And you call this excellence capitalism. And you talked a little bit about stakeholder capitalism earlier. So can you describe what you mean by excellence capitalism, how it differs from stakeholder capitalism?
Yeah, so maybe even to back up a little bit before that would be before stakeholder capitalism, which was developed in 2019, most companies would have fallen under what we call the shareholder capitalism model that was popularized by Milton Friedman, and it defined the purpose of a company to focus exclusively on increasing shareholder value. And if you think about if you're a company and you want to increase shareholder value, clearly your customers matter, your suppliers matter, your employees matter, your local communities matter, stakeholders matter, but they matter to your mission as a company to increase the value to your shareholders. And so in 2019, when the stakeholder capitalism model became popularized and all these companies signed on, including all the largest asset managers, BlackRock, State Street, and Vanguard, they redefined the purpose of a corporation, which to me on the surface, that is a very bold statement to redefine the purpose of a corporation. And what it did was it basically put all 5 of the key stakeholders, customers, suppliers, employees, shareholders, and local communities, all on equal playing field where there was no actual defining purpose, driving purpose, a mission of a company to focus on one versus the other. So if a customer says something versus an employee versus a supplier or a local community, how do you prioritize, or what's your driving principle? It really muddied the water, and it coincided with corporations becoming much more active in social and political agendas. And what's also interesting about that is there's been a decent amount of surveys that have been done by large corporations, Pew, Gallup, that show that a majority of Americans actually don't want corporations to be engaged in social or political issues. And so when we thought about this issue and started this excellence capitalism movement, it was really shareholder capitalism, but more defined. How do you actually increase shareholder value over the long run? And I think that's one of the things that was missing with the shareholder capitalism model is, are you increasing value for the short run or the long run? And clearly, as for most investors, and this is what Strive wants to do, is increase value to shareholders over the long run. And we believe that they do that by focusing exclusively on providing excellent products and excellent services over any political or social agenda. And so that's the excellence capitalism movement in a nutshell, as be excellent at what you are, define your mission, focus solely on that mission, and that's how you will drive long-term value to your shareholders.
Very interesting. And I've read some articles which describe your approach as anti-woke investing. Do you agree?
No, I don't agree. I would say that anti-woke means that you're just only narrowly focused on being anti-something, and we're actually pro-excellence. And so pro-excellence could be sometimes in alignment with people that might consider themselves woke, and sometimes it won't be. So it's just a different direction, a mission-focused direction, and doesn't necessarily have to be anti-woke, but at times there definitely will be differences of opinion there.
So we know that many are now blaming ESG investing for the current energy crisis because these three big asset managers, BlackRock, Vanguard, and State Street, have been impressing ESG standards on companies that they invest in. So could you talk specifically about how stakeholder capitalism has impacted the U.S. energy industry?
Yeah, it's really interesting when you actually start drilling down into the numbers a little bit. And so when you think about the energy sector in general, the energy sector has been underperforming tech for since about 2014. So let's call it 8 years. And early on in that period, I'd actually make the case that the energy sector was investing in capital expenditures that turned out to not be good investments. So this is not ESG related. It's just corporations that made financial decisions that turned out to be bad financial decisions. So call that, let's just say 2014 to 2017, 2014 to 2018, somewhere along that time frame. Then in 2018, you had ESG movement really pick up steam. And we like to say, kick the energy sector when it was already weakened from having made poor financial decisions. So from 2018 to 2022, you had the ESG movement constraining capital expenditures, capital investments by the energy sector. And so that's driven to the supply issue that we see today. And if you actually look over that time period, the energy sector has become significantly more profitable. So from June of 2018 to July of 2022, which incorporates the 2Q 2022 earnings, the energy sector's earnings are up over 179%. And if you can compare that to the S&P 500, where earnings are actually only up 48%. So over 3 times higher in earnings than the S&P 500 for the energy sector. If you look at stock prices, though, the S&P 500 is up 52%, which is pretty similar, 52% up in price, 48% up in earnings, pretty much in line there. The energy sector, though, is only up 7% in price. So you have an increase of earnings of 179%, but an increase of price of only 7%. Why is that? Well, part of what the ESG movement is defining is a movement away from oil and gas that, you can even argue that oil and gas companies will no longer produce oil and gas in 2030 or 2050, depending on which estimate you might look at. So they look at earnings today but discount any earnings in the future, where we actually would take the other side of that and think that fossil fuels are very important for the future of human flourishing in our globe, and specifically U.S. oil and gas companies are among the cleanest producers in the world, and they would be serving our world well and serve the human flourishing movement well by actually drilling more. And if they start drilling more, then they are extremely cheap, both just on a current earnings basis, but also on a potential for expanded earnings in the future. And so that's why we have an investment case that's out on our website, strivefunds.com, that makes the case that over the next 2 to 3 years, we actually see potential for the energy sector to be up a couple multiples, 2 to 3x in value. And so we're very bullish on the energy sector, and we think that we actually can unlock a lot of that value through Strive's mission. And it's why we started with Drill.
Very interesting. So let's talk a little bit more about Drill. It is the Strive US Energy ETF, ticker symbol DRLL, Drill, as you mentioned. And this has been a very successful launch. The ETF has gathered over $230 million in assets within 2 weeks of its launch. So tell us about the index that it tracks, what are the current holdings, and how's the ETF different from other popular energy ETFs?
Yeah, so the index that it tracks is the Selective U.S. Energy Regulated Capped Index. It's very similar to the other U.S. energy indexes. So BlackRock has a U.S. energy index, so does State Street, so does Vanguard. They are all extremely similar when it comes to price performance. So our index and each one of their indexes are all over 99% correlated in price. Our index has currently slightly over 50 holdings. IYEs are slightly under 50. XLEs is in the 20s, but substantially they're extremely similar. And so we think that as an investor is considering which ETF to invest in, that they need to consider corporate governance as a key principle in choosing an asset manager. So historically, when someone picks an ETF, they would likely look at risk and return and fee, basically three check boxes. We think that there is a missing fourth checkbox, which is the corporate governance process. And when you think about corporate governance, you think of, do I think that an asset manager can have a material impact on the direction of a company? Well, if you're an asset manager, especially right now, BlackRock, State Street, and Vanguard, they are the largest shareholder in effectively every energy company in America. And as the largest shareholder, they get to choose the board of directors. Well, that board of directors then chooses the senior leadership, which sets the mission for a company. They also engage with corporations. They discuss the future goals. Should a company be, restricting itself in emissions beyond U.S. regulations? What should their approach be there? How should they engage? How should they think about capital expenditures? And we think that through the ESG movement, it's constrained the energy sector from drilling, from simply looking at potential investment opportunities purely on measurable return on investment. And we think that that's led to an underinvestment in the energy sector, and that is our key differentiator. But our key differentiator is not in the index, where we think it's substantially similar.
So you mentioned why you decided to start with drill, but I know that you have other products in the pipeline as well. Could you talk a little bit about your future ETF plans?
Yeah, so currently we have 9 ETFs in SEC registration. We expect to be in the double digits of products in 2022. And how we're thinking about as we launch products is really a few different, I'll call it buckets. So bucket 1 is going to be providing substantially similar risk and return and fee products that meet the needs of the everyday investor, the retirement needs. What do you need in your retirement account? So you can then make a decision on who you think is the best steward, the best fiduciary to manage money on your behalf without having to make a sacrifice when it comes to the holdings in your portfolio. That's bucket 1. Bucket 2, which will be to come, will be actively managed products and thematic products. So when it comes to actively managed products, how we're thinking about it is very simple. Hire all-star portfolio managers with great track records and unconstrain them. People that have been successful in their current jobs that, would argue that maybe they've been constrained slightly, maybe by ESG mandates, where they come over to Strive and they have the same mandate that they, actively manage a portfolio, different kinds of portfolio. It could be a fixed income portfolio. It could be an equity portfolio, but focusing exclusively on maximizing return to shareholders over any political or social agenda. That's the second bucket. The third bucket is thematic products. So products that we think are missing from the marketplace that make sense in a portfolio, and more to come on those. But we think that there is a lot of missing thematic products, long-term themes that might be 5-year, 10-year themes that we think the investment community will have an interest in their portfolio, and we plan on launching all 3 of those sorts of products over the next year.
Excellent. So Strive will be competing with BlackRock, Vanguard, and State Street. And these three firms, the big three alone, manage over 20 trillion in assets. They have thousands of products and a lot of voting power. How does Strive plan to compete with these giants?
Yeah, so we will be taking an active seat in the boardrooms across corporate America. We'll be presenting shareholder proposals. We have a head of corporate governance, Justin Danoff, that has been effectively the leader over the last several years in kind of the alternative, the post-ESG movement in these boardrooms, but with very little shares. And so we will be presenting these proposals. We hope that BlackRock, State Street, and Vanguard support them with us. And so there's really, two paths here. One will be that we get support from the broader investment community in our proposals, and we institute substantial change very quickly. Or two, we don't, and investors will see very clearly how we differ, and then every investor in America will have a decision to make on who's the best fiduciary for their money.
So going back and talking a little bit more about climate change and ESG. So we have seen a surge in extreme weather events, including wildfires, heat waves, flooding. And we know that these are all caused by global warming. And of course, these natural disasters claim thousands of lives, cause millions in economic losses every year. And there are some studies that reveal the role of fossil fuel companies in climate denial. For example, there are some studies which show that Exxon had known about the causes of climate change for decades and the risks that climate disruption poses, but they did not address it earlier. Now, when they are being pushed to address ESG and climate change, these companies have been investing a lot in new low emission technologies, carbon capture technologies. They are trying other ways to reduce their emissions. And we know that many investors believe in climate change and they want to support ESG causes. So what do you tell such investors?
Well, first off, I would say, at Strive, we aren't deniers of climate change. The disagreement is in the correct place to discuss such changes and the correct answer for such changes when it comes to corporations. So as an example, we think that solar and wind are not reliable sources of energy that really are only standing up because of government subsidies. But nuclear energy, as an example, is probably the most clean source of energy we even have. And we're very bullish on nuclear energy. When it comes to oil and gas, when it comes to natural disasters, I would argue that there's never been less deaths in our world from natural disasters than there are currently. And when it comes to our oil and gas companies, they clearly have a role in this, but we should be regulating them through our political process, where every citizen has one vote, not through the asset management industry where, a handful of, asset managers control or constrain these companies. That is not in the interest of most shareholders. And for people that want to support the ESG movement, invest with BlackRock, State Street, and Vanguard. And we will not be the best client potentially for those people, but we think we are the best client for the majority of Americans that don't want corporations to be incorporating social or political agendas in their investment process.
Excellent stuff. That's all we have time for today. Congratulations on the very successful launch, and good luck with your upcoming launches. Thank you so much for joining us today, and hope to talk again soon.
Thank you, Nina. Appreciate you having me on.
So that was Matt Cole from Strive. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.